All right, episode 55. I'm Ryan Greiser, and I got my guy with me, Fran Walsh, and we are in the brand new Opulus Podcast recording studio. First episode. We figure if we mess this one up, it'll just be just be the two of us to get this thing going.
We got some awesome guests coming up shortly, so we're like, if we're gonna mess one up, let's just have it just be us two. But we're fired up, dude. It's awesome in here. We were slaving away yesterday trying to be blue collar guys for once, and
not for me.
Yeah, we learned this is why we're in the finance world, dude. We're not good at anything in that world. Trying to put up a few simple walls in the back, which if you guys are watching the video, look fantastic. Took us all day. Probably a 30-minute job for a regular guy.
Maximum.
But
we learned we definitely got to stay in our lane from here on out.
But yeah, we're fired up. We think it's going to be a fun improvement. We're really excited about it. And we think it's going to give a better experience overall to the podcast, especially when, doing some podcasts via Zoom. It's great, but there's nothing like being in person with someone. We think it's going to make the conversations go much better, much more personable feel. So we're fired up about that.
Yeah, especially if you're in the Doylestown area, willing to come to it. You think you'd be good on the podcast? Come on by, especially ladies. We need more females on this podcast. We know we've been told that. So raise your hand. Come on in. We're ready to have you on.
Absolutely. Yeah. And we always say, if you're someone who wants to come on, we get DMs all the time now, which is pretty cool. We're at the point where people ask to come on, and we don't say that way. Like come on the podcast. If you're someone who wants to tell your story, help promote your business, tell your story as an athlete, whatever the case may be, just reach out to us. We're more than happy to have anyone and everyone on. We like telling other people's stories, helping people promote themselves. That's the whole reason we're doing this.
Yeah, exactly. So we got two good things to talk about today. Fran, why don't you get us started, kick things off?
All right, so, what sparked mine, I actually wrote a newsletter about it a couple weeks ago. We're big Twitter guys now for anyone who follows us on social. So we're always active on there now. And, there's an ongoing argument going on in the financial Twitter world regarding life insurance. And, for those of us who know Ryan and myself, we actually came from a larger firm. Back in, before 2019, we worked at a larger company for a few years. And, essentially what they were a financial planning shop that was under an overall insurance company. So what they did was they really pushed insurance. They wanted you to sell that. They're like, yeah, you can do financial planning, you can do asset management, you can do all this stuff, but they wanted you to sell insurance, right? So,
and not just wanted, but so much of our compensation was tied to that. So if you had X amount of policies, you get this trip to the Bahamas and all this other stuff that was, an obvious conflict of interest. But I'll digress for now.
So all this to get into, that was obviously a major piece as to why we were like, hey, we got to get out of here. We want to do what's right for our clients, which, we always did. But, when you have someone screaming down your neck, being like, well, can we sell insurance to them? It's like, oh, dude, come on.
And there's clear conflicts of interest with
exactly.
it too.
So this was obviously a major reason in why we ended up starting up our own firm. But all of this to say, obviously, we are not huge fans of talking about insurance because of our previous history with it and the negative connotation it has in the industry. But at the same time, it is a very important piece and something that most financial plans do really need in some way, shape, or form. So essentially, all that backstory to talk about, do people need insurance? And in most cases, the answer is yes. And something I just want to talk about briefly is, when are you in a situation that you might need insurance? And, once you figure out, do I need insurance? The next question is obviously, okay, well, how much do I need? What kind? All that kind of stuff. So, essentially what I'll get into is just a very brief discussion about this is just, if you are someone who just got married, just bought a house, about to have your first kid, you're probably someone who needs insurance for the sole reason that, hey, you just bought a house, you want to have that covered. You don't want to be leaving your debt to anyone else. You just got married. If you guys, are now living together, you're relying on each other's income in some way. Most households nowadays rely on dual incomes, right? Now you're just all of a sudden, you're responsible for more things than just yourself. When you're 22 years old, you're renting for $1,000 down in the city. You don't own anything. You don't need insurance. But once you all of a sudden you have responsibilities, you own a house, you got your wife or your husband depending on you, you got 2-3 kids. All of a sudden now, hey, if something happens to you, you could really mess up your entire family's situation.
Big time.
So you want to make sure that, hey, whether I'm here or not, all my shit is taken care of. So if you're someone in that situation, right, how do you approach how much do I need? Very simple. What we use is very easy formula to understand. It's called the dime formula. First, cover your debts, right? Really easy here. You got any kind of loan, credit card balance, student loan, anything that you owe money on. Last thing you want to do, something happens to you, God forbid, all of a sudden your family's got to worry about paying off shit that you didn't have taken care of. Next, income. Naturally, wife, kids, like we're talking about, anyone that else relies on your income. If you have like parents that live with you that, need help, things like that, you want to ensure that your income is taken care of. Typically 5 to 10 years is what is, suitable for a family to help get back on their feet.
Yeah. It'll be different for everybody a little bit, right?
Yeah.
So like if your wife, in my case, right, has the ability to earn income and works, the number can be a little bit less. But if your spouse just wants to stay at home with the kids, you might want to increase that number a little bit more.
Absolutely. Next one's a big one, mortgage. Nowadays, which Ryan's going to get into a little bit.
Don't get me started early.
Yeah. Housing is very expensive nowadays, right? So a lot of households are basically, they need both incomes in order to afford their mortgage. So what's an easy way to really mess up your family situation is if something happens to you, all of a sudden your family can't afford that house anymore. They got to sell the house, figure out where they're going to live, make sure your mortgage is covered. And lastly, education, or, another way to think about it is just goals. If you're someone that's like, hey, I want to pay for my kids' college, I want to pay for, weddings, whatever those things may be, you want to make sure that, hey, whether you're here or not, all your bases are covered. So a really simple way to look at this is, figure out, one, do I need this? Two, of the dime formula, which of those things actually apply to me? Tally up those things, and then simply just know, hey, this is going to evolve and change over time. If you're 24 years old today and you just bought, a condo down in the city, and, your insurance need is not nearly as much as it might be, 5-10 years down the line when you're married with 3 kids living out in the suburbs in a, $600,000 house, right? So something that's constantly going to evolve, just like any other part of your financial plan. Modify, make adjustments as needed. But it's not this harsh black and white thing that people make it out to be, right? Most people need it. They need just a basic term policy, cover all the things that they want to have covered. And, that'll be sufficient just to know that, hey, not worst case scenario, it's not something anyone wants to talk about, but you're going to be good.
Yeah, and to your point, Fran, I think about my personal situation when I approach my life insurance, it's just that I want to make sure my car is paid off if something happens to me, any other personal debts that I have taken care of, my income's replaced for my wife, and then I do have my education covered for my kids, and my mortgage is fully paid off. So I can really put my wife and my family in a really good position. God forbid something were to happen to me. But to your last comment is I have a term insurance policy personally. Why? Because all those things I just mentioned are going to be temporary liabilities that I have, right? So when I'm younger, I have a higher mortgage payment. I haven't saved as much money for my kids. I haven't saved as much money for my future. And I need to replace some of those things if something were to happen for me today. But fast forward, my kids are 18, 19, 20. College isn't an issue for me anymore. That's covered and taken care of. My mortgage will be just about paid off at that time. And I'll have saved significant amount of money from now until my kids are 20 years old. So fast forward 20 years, the debt, the income, the mortgage, and the education expenses are no longer relevant for me because I can now self-insure for all those things, or those liabilities are gone. So for me personally, that's why I love to use a term insurance policy to cover those temporary needs. And the $2.53 million of term insurance I have is dirt cheap. It's like $100 a month. So I will gladly pay a little over $1,000 a year to guarantee those things are satisfied for my family.
Yeah, and if you're someone who's like considering this, it's something that's probably better to attack sooner than later because, the older you get, the more health risks you have, the less healthy you're probably going to be. Hopefully not, though. Hopefully you're still working out, being a beast. But all those things are natural. So it's going to get more expensive over time as you get older naturally because they're looking at health risks. So even if you just get something small and basic in place, it's probably good. And the last thing I want to note on this is most people's first, kind of deferral of talking about insurance is like, oh, I have that through work. Typically what you have through work is somewhere between 1.5 to 2x of your salary.
Sometimes 3, yeah.
So say you make $100,000, you probably have like $150,000 of life insurance. which is something, yes, but you just look at all the things we just talked about. 150 grand if you got a $400,000 mortgage, and it doesn't even make a dent in it. Plus, you're not even talking about any income on top of that for your family. It's clearly not sufficient for all the things that we just talked about. So essentially, just to summarize here, it's, you want to make sure everything's taken care of. You don't want to be that guy. Everyone's been to a funeral at some point in their life where unfortunately someone was older and then they didn't really have anything. So now the family has to pull money out of their pockets to pay for a funeral, pay for all this stuff. You don't want to be that person.
No.
You want to be the person that's hey, I got everything taken care of. You guys are set and everything's going to be okay. Obviously, we don't want any of this to happen, but you want to make sure planning for the worst, you're still got your shit in line.
Yeah, and when it comes to the group benefits and life insurance that your company provides you, what's critical to know is that those are typically not portable. In other words, when you leave that company, that does not go with you.
Yep.
The company benefits will be there for you. Life insurance will be with you while you were there. But when you're gone, that benefit is gone. A client of ours recently made that transition, had a huge life insurance policy available to them through work, left the place, joined a new company. Guess what they got at the new company? Nothing.
Yeah.
Right? Which was fine because they had good personal insurance. But if they were solely relying on that group policy, it didn't go with them and they would be left with nothing. God forbid they weren't healthy at that time. So be aware of it, leverage it, benefit, but don't rely on that to protect your family because it's most likely not guaranteed to.
Yep. Absolutely. All right. I'll kick it over to you for your piece here.
All right. Let's talk about mortgages, interest rates, and all of the fun stuff that comes along with it. So today's...
Just make people cry a little bit with how,
exactly.
with how expensive it's going to be for home buyers.
Or feel really good about locking in that 2% that you did in 2020, 2021, if that's the case. So, today's September 7th, 2023, and pulling up Google here, mortgage rates are in the mid sevens. Is the national average, might be different in each area, but if we look at it in the mid sevens, that is dramatically higher from where rates were, in 2019, 2020, in the high twos if you bought with some points, or the mid threes. And I really think that people dramatically underestimate the long-term effects that rising rates, specifically on mortgages and home purchases, have, not just on the price of things today, but the true impact of the costs that it is over the course of time. Right now, listen, the Fed raised rates so they could combat inflation. And in theory, when rates go up, things should slow down, buyer pool shrinks, and prices go down. We'll talk about that in a minute. But when we take a look at the dramatic effect that rising rates have on prices, look at this example. Someone we were talking to is buying a home, right? They're looking around an $800,000 price point, which, 5-10 years ago, that place must be huge.
Yep.
Well, in the suburbs of Philadelphia where we're at, an $800,000 home is built in the 70s, needs work done to it, and is a nice place, but not the creme de la creme that you would expect just 5-10 years ago buying an almost $1 million home. So let's walk through this example here. So $800,000 home, 10% down payment at a 3% interest rate would come out to a monthly mortgage payment of about $3,700, right? Now, over the full lifetime of a loan, 30-year mortgage, that means that the total interest payments would be about $372,000. So if you had a $720,000 payment, or principal payment, with the $372,000 interest payment, the total cost of that mortgage is just under $1.1 million. So buy for $800,000, small down payment, $1.1 million. Yeah, that's a decent amount of interest, but nothing crazy, right? The numbers will really work out in your favor.
Seems to make sense in your head, right? You can make that sound okay.
You can justify it, right? Quite substantially, right? But let's say we jump those rates up now to 7.5%, where they're at today, instead of the 3% that they were in 2020 and 2021. Same scenario, 10% down, $720,000 principal payment over the lifetime of the mortgage. But now, instead of a $3,700 payment, you're paying $5,700 a month now. Same amounts going to principal, but an extra $2,000 a month a month in interest payments. Now, if you extrapolate that over the lifetime of the 30-year mortgage, instead of making $370,000 of interest payments, you're now making over $1 million of interest payments on top of the 720, right? So to pull that together, the true cost of a mortgage at 3% is about $1 million. You got to tack on an extra $800,000. Same home, same price, more than double the interest rate. Now you're paying $1.8 million for that same home instead of 1.1. So people dramatically underestimate the true impact of the rising interest rates that they have. Now, listen, can you refinance at times? Yeah, but you got to qualify. You got to have a good job. You got to assume that the home price is still high enough that's there. With home prices drop, you might not be eligible for a refinance. So can you? Yes. Will you probably be able to? Sure, in time, but don't count on it, right?
Knows?
In the next
There's
year,
no
2, 3, because of all these variables that go into it. And, bank regulations have the ability to change too. So it's kind of crazy, the huge impact that comes with the rising rates.
Yeah. And the one thing you always hear is like the boomers talking on, on this topic saying, oh, well, when I was growing up, interest rates were 15, 14, 15%. It's like, yeah, dude. Well, the average income back then was $35,000 and you were buying a $70,000 house. Like that was your income was a 50% margin of the house. Nowadays, the average household income is $70,000. The average house is $450,000.
Yeah.
Like so you're talking 1/7, 1/8 there.
Yeah. So I have this data, right? Because this is the thing when we posted it on Twitter, we had all these boomers say, yeah, well, you should have seen what it was like in the 80s when it was at 15, 17%. Like, yes. All right. Like the interest rates, yes, 15 and 17% is higher than 7 and 8. Thank you for pointing that out. Right. But what people didn't talk about on Twitter when they were yelling at me about it is the home price to income ratio. Right. So in the 80s, it floated right around between 4 and 5%. So if you made $100,000, you're buying a home that was like $400,000-$500,000 was that ratio, right, to your income to that. But now it's 7.5, right? So it's the equivalent of, instead of you making $100,000 and buying a $400,000 to $500,000 home, you're buying a $750,000 home. That's how much income, almost double the amount of income that someone brings home is going towards housing today versus what it was like in the 80s, even with the increased rates. So it's not necessarily apples to apples. There's so many things to take a look at with it, but there's no doubt about it. People are spending so much more money today on getting into a home than they were back in the 80s.
Yeah, I always come back. I think I told you this story. My grandmom used to always tell me when her and my pop bought their first house in Philadelphia. This is probably in like the 60s. Probably around early 60s. My grandpa was working for Verizon, I think, making like $18,000 a year. Mm-hmm. Their first house was a 3-bedroom, 3-bath house in Philadelphia. Like a nice place. It's a really nice place. And it cost $30,000. Can you imagine being like, yeah, I can pay off my mortgage in like 2 years probably? It'd be awesome.
Yeah. Like it is. It's wild to think about it. I mean, even in my personal situation, right? Me and my wife bought our home in Doylestown in 2019, right? We bought it for like $460 at 3% rate.
Yep.
Right. So like my monthly mortgage payments, floating right around like $2,500, $2,600.
Yeah.
Right. 2 people in our neighborhood just sold their home. They're a little bit nicer than ours, more redone, but for just under $900,000. So I bought my home in 2019 for about $460. My neighbors just sold their home 3-4 years later for just under $900,000. And if I were to buy that same home at $900,000 at a 7.5% interest rate, right, my payment would be like $6,000. So like the $2,600 I'm paying today versus $6,000 for, the houses didn't change that much in the last 4 years. It is a tough and challenging time to buy a home.
Well, that's a great point because, what do most people think when they hear that? Oh, that's a great reason to, why don't you sell your house? You'll make $400,000
and go where?
Yeah, and go where? That's a great point to talk about, right? We have a client who, similar situation to this, has a sub 2% mortgage rate, like 1.8%.
Yeah.
And they were telling us like,
we thought we was wrong. Like we got the statement, we're like 1.8%.
I was like, this can't be right. But they were talking about potentially selling their place and moving somewhere else. And we were like, absolutely not. Like, we're going to show you why your situation is so good right now. Just because the numbers, it doesn't make sense because, like wherever you're going, you're going to be paying double for essentially the same thing as you have now.
Well, and that's what it was. They would almost be dramatically downgrading and doubling the cost of the situation that they were in. And that's why home prices are staying elevated for that situation. Is you got people that are in some cases unbelievably in the high 1s to 2s and 3s are like, I'm not selling my place. Like they're stuck, right? You see these memes on Instagram like, hey, that starter home that I bought, I'm locked in at 3%. Well, it's my forever home now.
Yeah.
But it'll be interesting. I think that's where we're going to see a lot more renovations come in for people like myself that have a great neighborhood, great home, that are in the 3s for their mortgage rates. Like, it doesn't make sense for me to go anywhere, but to update the home makes a ton of sense. But we got a lot of people that are stuck in their mortgages and they're not going anywhere. And that's why you see prices staying elevated because people need to get a lot out of their house to be able to transition somewhere else. Otherwise, they're just not selling. So inventory's low. People still want to buy even at these higher rates, but it's just a challenging environment for buyers for sure and for sellers to justify moving, especially if it's within the same neighborhood.
Yeah. So, I mean, well, all this leads to, okay, if you're someone like me who rents, right? And you're looking to buy in the future, right? What do you do? Like how do you make this work? Do you ride it out, hope the market crashes, or do you just say, screw it, I guess I gotta buy this and just pray I can refinance down the line? Like it's a weird predicament people are in because this is the first time ever where houses are here, interest rates are here, and it's like, okay, nothing's budging. So how do people budget for that situation?
Yeah, and as you so let's play this out, right? So where we're at now, prices are elevated, rates are elevated. So the Fed said in the future, 6 months, a year, 18 months, 24 months, they're going to drop rates down. How dramatically, time will tell based on economic factors. But rates will come down at some point, right? So today, prices are high, rates come down. Well, now what happens? The buyer pool will open up because now mortgages are more affordable, lower cost. And if prices are at where they stay elevated and stay where they are now, there's only the potential for them to increase from here if the economy is stable and then rates begin to come down. For people who are looking to buy, sell, or people who are looking to buy, like that's a problem because now prices are going to just go up higher. Rates are coming down, so the payment might stay the same, but you're going to have to fork out more cash for a down payment to get into that place and be able to qualify for it. So that's one thing when you look at rates coming down. And people have been waiting for a long time for the housing market to crash. It just hasn't happened. Yeah. So what are you going to do? You going to wait and rely on it as prices continue to climb potentially? This is not the case. At the end of the day, what we think most people should consider is you just got to buy what you can afford today and then be adaptable. The people who over leverage themselves, trying to buy a really expensive home at a high mortgage rate could be in a lot of trouble. But on the flip side, if you just sit around and wait to buy, there's no guarantee that things are going to get cheaper either. So at the end of the day, you got to make a real clear assessment of your scenario, buy what you can afford, and make sure whatever you do buy, you could see yourself being in that home for an extended period of time.
I was just pulling up an article here. I don't know if you saw it yesterday. Actually perfectly, very timely for this conversation. New York and California both just implemented some sort of law yesterday. I don't know all the details of it, but I just saw some details saying it could impact the housing market in the short term. Basically, Airbnb is getting restricted there. So now anyone with an Airbnb, whereas before it was just kind of like you do what you want to do. Now they have to register with the state. You must live in the building. You can't leave your house to someone anymore. You have to be in there, and you can only have 2 people max staying with you.
So you can't rent out the full home?
No.
Really?
Yeah. So
just new ones or all existing ones?
I think all existing ones. Listings were shifted to put into effect on September 5th. 4,000 were taken offline yesterday. I guess they're just I'm not doing this anymore. They're expecting 9,000 more by the end of the month.
That's interesting. Well, because that's such a huge side hustle for a lot of people, right? Like real estate investors that don't want long-term leases.
Yeah.
There's buy a place, invest in it, rent it out. That's a dramatic shift to take of just all of a sudden all homes, here's the rules, and that many listings. I wonder how many listings there actually are of those 4,000. Like what percentage? It seems like a low number, but
it does seem low. So I don't know. I guess we'll see. I mean, the article literally came out 12 hours ago, so I'm sure there's not as much data out yet as there will be. But that's something we'll keep you posted on. I just saw it was interesting as it's relating to this conversation. Any news that people get of like, okay, could this be the housing market coming down? You're like, okay,
yeah. I don't want it to crash, right? But for some of our clients, I'd like they're looking at buying
personally
stuff.
want it to nuke.
Burn.
And then I will call our clients and apologize, but I'll be like, but now I'm in. Now I'm riding high with you. Now we're rooting,
stabilize things,
we're
baby.
rocking it up.
Yeah, right. So at the end of the day, when it comes to buying a home, rates affect things tremendously. No one would expected prices to continue to fly up the way that they have with the rising increases that we have in rates. But at the end of the day, you got to buy what you afford, buy what you can afford, have a long-term vision for that property, and avoid the transaction fees that come with it, which is a whole nother conversation. And ride it out because it's an interesting time that we're in. Yeah,
and at the end of the day, it's a home. Yes, we like to look at the numbers of things and say, hey, like, is this financially a good investment? But, if it's a place you love, in an area you love, and you see it as somewhere that you could be for a long time, live there with your family, and you're going to really enjoy it, and you can make it work financially, it's not the end of the world if you don't make a ton of money.
No doubt.
So, all right, man. Good first episode in here. We'll see. Hopefully the audio sounds good. Hopefully the cameras are still working. And, hopefully we'll have
this isn't our last one.
Yeah, hopefully we'll have a great bunch of episodes in here.
All right. Appreciate you guys.
Thanks, guys.